Hi, I'm Praneeth. My project is Absorption and Marginal Costing. Introduction to the topic. Before we allocate all manufacturing costs to product regardless of whether they are fixed or variable, this approach is known as absorption costing and full costing. However, only variable costs are relevant to decision making. This is known as marginal costing or variable costing. Definition of absorption costing and marginal costing. Absorption costing. Absorption costing is a costing system which treats all manufacturing costs, including both the fixed and variable costs, as product cost. Marginal cost. It is a costing system which treats only the variable manufacturing cost as product cost. The fixed manufacturing overheads are regarded as period cost. Here we see the diagram of absorption costing. Actually, cost is divided into manufacturing cost and non-manufacturing cost. In the manufacturing cost, there are direct materials, direct labor, overheads, whereas in the non-manufacturing cost, period cost is there and profit and loss account. After the direct material, direct labor, overheads, finished goods, cost goods of goods sold, into the marginal costing, manufacturing of cost, direct material, direct labor, variable overheads, fixed overheads, finished goods, cost of goods sold, then the profit and loss account comes. Presentation of cost on income statement. Trading and profit and loss account. Absorption costing. Sales excels less cost of goods sold excels variable cost of goods sold gross profit x product contribution margin x less expenses less variable non-manufacturing costs selling expenses admin expenses other expenses variable selling expenses variable admin expenses other variable less total contribution expenses variable and fixed manufacturing less expenses fixed selling expenses fixed admin expenses other fixed expenses net profit or net loss. Example: a company started its business in 2005. The following information was available for January to March 2005 for the company that produce a single product. Selling price per unit will be 100 and direct material per unit 200, direct labor per unit 10, fixed factory overhead per month 30,000, variable factory overhead per unit 5, fixed selling overheads 1000, variable selling overheads per unit 4. Budgeted activity was expected to be 10,000 units each month production, and sales for each month were as follows: January, February, March. Units sold 1800, 1100. Unit produced 1000, 1300, 900. Required. Prepare absorption and marginal costing statement for the 3 months. Absorption costing. January, February, March. Sales was 1,80,000 and 1,10,000. Less cost of goods sold in $65 equal to 65,000, 52,000, 7,000,